you can see what's at stake here. It's the sentiment, and they're fighting for people's sentiment. Is it believable that actually you'll find that the oil market demand growth is going to grow enough to absorb this excess and absorb what we're going to bring back online? Hi again, welcome to another special edition of the World of Oil Derivatives podcast. I'm Greg Newman, Group Chief Executive of Onyx Capital Group. I'm joined with Jorge Montepeque, our Managing Director of Benchmarks, and Harry Tchilinguirian, our Group Head of Research.
How did you?
Today, the special episode is about the growing divide between IEA and OPEC's demand forecast. I'm sure key members of the oil industry and general viewers and analysts are all aware of this, and we thought we'd take the time to get stuck into it. So at the heart of the current demand debate is the deep divide in opinion between the IEA and OPEC, which is becoming acrimonious. Haitham Ghais, OPEC Secretary General, has recently come out on a forum of an energy market consultant saying that the IEA's narratives for oil are dangerous, especially for consumers, and could lead to unprecedented volatility. Now, this is not the first time OPEC has taken a serious jab at the IEA. OPEC Secretary General recently wrote an opinion column on the OPEC website warning of the disastrous consequences of a world without oil. Harry, can you start us off? Can you tell us what this is all about?
I think the current controversy right now between the IEA and OPEC, as the OPEC Secretary General himself puts it, is, when will oil demand peak, plateau, and eventually decline? And of course, at what rate? So these are all very important questions because when you look at oil demand, there are implications in terms of future investment in the oil sector and our ability not only to meet future oil demand growth, but at the same time cater to existing demand. So the debate right now is becoming acrimonious because it's really fraught with emotion as it's taking place against a background of energy transition and the path to achieving net zero.
Okay, thank you. And Jorge, any thoughts on the early start of this conversation?
Well, there is a huge debate between the two organizations, and I think it's fair to say that they should be, and they are, self-serving comments. The IEA has been on a path to sell to us and suspecting customers transition, push it hard, and one could expect that they would take some pride in consumption going down or not growing as expected. So their forecasts, people have been complaining, are lower than normal, or they should be. And the IEA has been a little bit wrong in previous years because it didn't account for the proper rise in consumption post-COVID. However, the economy is not doing so well, and OPEC is very bullish about consumption this year. But again, the economy is not doing so well. And this has resulted in two groups being created. Some supporting the IEA, that demand is not going to be as much. A vast majority of consultants and bankers saying that consumption is going to be more along the side of OPEC. And at the end of the day, we can see what the price has done.
I think it's a good way to, define that. It's self-serving on all sides. That's what we're all like as humans. It's what we all like in our jobs, our careers. That's kind of that's what you do. So it's interesting to see, generally speaking, people in the oil market, I would say, have a preference for oil prices to be higher. The oil industry has more capital in it, is better for the functioning of refinery economics, you name it. And of course, end user governments want generally lower. So I guess that's a good starting point. But let's get more into the details. So before diving into the long-term forecasts, of course, the way an S&D model is going to work is you're going to get the near term, you're going to get as precise as you can about that, given it's near, and then use that as a stepping stone for the longer term. So Harry, what is the main difference then in the 2025 demand forecast?
Greg, yeah, you're absolutely right. I mean, before looking at the long term, the stepping stone, what are people looking at today? And as Jorge pointed out, I mean, the divide is actually quite wide, and you're looking at the IEA seeing growth this year at mid-year, right? Seeing growth for the entire year of just shy of 1 million barrels per day. OPEC, on the other hand, is holding the ground of a 2.25 million barrel a day increase. Now, when you start looking at this difference, 1 million barrels per day, That's easily could flip any oil balance on its head, right? And so the difference, looking into next year is also quite significant. So that's really the starting point of the medium-term forecast. And we're looking at oil demand from the IEA still stable at roughly 1 million barrels per day, while OPEC is still standing its ground with a more robust view and an increase of around 1.8, 1.9. So in terms of absolute level of demand, when you look at these kind of growth rates, you have the IEA ending up with an annual average in 2025 of about 104.2 million barrels per day, while OPEC's estimate for the annual average is 2 million barrels a day above that. So at 106 million barrels, or just about a little bit above. And so this obviously is a very different starting point when you start looking into the future.
Yeah, sorry to just, if you just go back a little bit, right, just kind of first principles. So supply is a lot more straightforward because, there's quotas, there's loading programs, and to some degree there's visibility on storage, there's ship tracking. So you can kind of get a good sense of what's moving around the world. But demand is so much harder. It's even hard to know if it was to get any source of truth backdated. So even when I was in the OPEC headquarters myself speaking with the Secretary General, it was, we were having this debate about IEA, it was about a year ago. And we said, but what is the truth though? As in like, who was proved right? How do you even prove who was right in the first place? I think he said basically IEA's own demand kind of truth was proving themselves wrong. I think that was that. And but at the end of the day, just for the audience as well, like how are we getting precise about these numbers anyway? Because they all are ultimately, even when it's happened in the past, going to be an estimate. So you could always just fudge the estimate of what it was in the past. Do you see what I mean?
Oh, for sure. I think there are two things. There's a forecast in of itself as how people look at oil demand evolving over the coming years, and obviously people need to plan around that. They have a view based on investment plans, final investment decisions to be able to grasp what supply is going to be looking like in the years to come. They may have a view on what OPEC supply policy is going to be. But when it comes to demand, if you were to look at the annual average of demand as quoted by the IEA, OPEC, or even the US EIA short-term energy outlook, the figures will all be different, even in the past, even in the historical data. So, what you're looking at here is, in terms of prospects, is how people gauge the change. Mm-hmm. So, and of course, that change being more or less important, depending on which forecaster you want to rely on. That change is coming off a baseline, and so as we see already for 2025, we're looking at a difference of 2 million barrels per day. So you extract that into the future, and ultimately you're going to have wide divergences that emerge in the final outcome. Mm-hmm. And that could obviously lead to very different conclusions as to what's going to happen as a result, right? Yeah.
But then, sorry to press this initial point, but it's just also, you did say that 1 million barrels a day can make a huge difference. And obviously I'm not going to disagree with that. But at the same time, if you can't really know the truth, even in the past, 1 million barrels per day extra when you've got Guyana increases, like that'll be massive this year. Shale oil, no one ever seems to have a handle on shale oil growth, even again in the past. There's a lot of incremental growth around the whole world that adding up to 1 million barrels, Venezuelan sanctions, missing barrels, it actually doesn't seem that much. Is that fair to say? Or
I think what you're really highlighting here is that, if we look at both sides of the oil balance, right, and you're mentioning a number of countries where there is a significant supply growth to come, whether it's U.S. shale oil or new joiners such as Guyana. Obviously, in the future, we may see more from Canada and so on. And so you look at these increases and you go, well, alone, if you were to take the IEA's estimates in terms of demand growth, well, you have non-OPEC supply that could easily fill the gap. Mm. So where does that leave OPEC? And so this is some of the difficulties when it comes to forecasting oil demand. And we see big differences in the near-term forecast. They're quite prominent when it comes to China's oil demand growth. There's a big divergence between the IEA and OPEC. There are differences in U.S. oil demand growth. And in each case, I mean, the thing is, at the end of the day, these differences obviously come from differences in economic growth assumptions, and perhaps more importantly, in terms of how sensitive is oil demand to those economic growth assumptions. So you have two things. You have the economic growth on one hand, driving oil demand, and then you have the sensitivity of oil demand to that.
How do you convert that economic growth to an actual barrel number?
Exactly. And so the other thing, of course, is, when many forecasters look at oil balances, especially at oil demand, the obvious thing would be to build the forecast from bottom up. So look at every product and try to figure out, where they're going in terms of demand growth. And in this case, one could say that, for example, something like gasoline has largely, if not more than recovered the losses it suffered during the pandemic.
From a demand perspective.
From a demand perspective. Yeah. On the other hand,
it's now being the big driver.
Yeah. So, but that simply then reverts to what its long-term trend should be.
Yeah.
There may be some more catch-up in jet fuel. Then after that, you start going, well, what are people placing their finger on? And you go, they're really putting their finger on NGLs, naphtha, as the key driver, not just in the short term, but also in the long term.
And that's, in essence, I think that's great, because we will get to that. Just to take the next step, again, bring Jorge in here. I think, okay, so OPEC have given a very clear short-term forecast, significantly above the IEA's. That's clear for next year. Ultimately, why is this so important? Why are tensions rising now? Because it's not new for them to disagree, but the tensions are rising now because they're in the midst of a cut. They've just made a very clear extension to their cuts, and they know more than anyone else, OPEC, Al-Mahana's Oil Leaders, fantastic book, talking about how they view oil markets, and that sentiment is as much importance, if not more, for moving the price. And ultimately, it's people's perception of the demand growth, which is hugely important right now. So it might be something in the future, but the price will be affected by people's opinions on it now. And it's in the balance, right? We're having these sentiment kind of basically battles. We're shifted max short on the managed money side only very recently, only to bounce back again when it got overextended. Clearly there's trade houses, majors, physical players who feel the opposite. And that's kind of the raging debate that you're actually seeing play out in the price action. So you can see what's at stake here. It's the sentiment, and they're fighting for people's sentiment. Is it believable that actually you'll find that the oil market demand growth is going to grow enough to absorb this excess and absorb what we're going to bring back online? Because I think everyone knows, they want to bring oil back online if it's sustainable with the price, but will they? And if they do, will it destroy the price? And they're saying, no, we've got this extra 2.5 million barrel per day increase in demand to soak that up. And this is a great time for you to come in. It's a little bit, would you not say, coincidental that it coincides with their cuts, essentially?
I think you hit the point. OPEC is under a lot of stress. Several key members who want to increase production, bring back what they have been cutting. And if there is no extra demand for it, then the demand has to be created by a fall in the price. And what they want to make sure is that the price doesn't fall too much and remains above 80. Otherwise, the budgets are destroyed. By definition, OPEC will always have a more bullish view on where demand is going. The IEA will have the opposite view. And at the end of the day, they are losing a little bit the thread, because where the action is happening is in the global south. It's not in the north. It's what is happening in Brazil, what is happening in Africa, in Latin America, in Asia. And in the past, these have been the areas that have rescued OPEC. The question is this year, with the trade wars happening between Europe and China, America and China, is China going to continue growing at the pace they have been? And I have been talking to people in the market, and they say for the Asian part, there are only two countries that really matter, India and China. If those two countries are not growing at the pace they have, global demand will not be reflecting the numbers OPEC is hoping for. But if we go back to the price, the market is sort of backwardated. The curves are improving. The price bounced back from the 80s. And now we're heading into the period of summer demand, which tends to be higher than normal. So things are going a bit in the OPEC way. But if we look at the greater economic interventions by the governments with the tariffs against China, by the US and Europe, I think the growth is going to moderate quite significantly.
Okay.
And sorry to add an extra point, one of the key outsiders and forecasters told, I asked him, where are you in this battle? And he smiled very cheekily and said, right in the middle.
Of course. No one could accuse you of that, Jorge, I don't think. But Harry, going back to what Jorge was saying, what's been rescuing, as he says, but in general, where the demand's going to come from. So where are the primary divergence between the two demands?
So as we're just, Jorge was mentioning China. I think if you look at the IEA, OPEC, any consultant, any bank analyst, sell-side bank analyst, the bulk of oil demand growth is in Asia. And as Jorge rightly put out, it's essentially India and China. So clearly, I think there's a consensus that growth in India is going to hold up. The bigger uncertainty is China. So whether it be trade wars impacting the country's economic activity, whether its own property sector continues to weigh on the economy, whether it's other factors that come to affect Chinese economic growth. If China doesn't deliver on a 5% GDP target, then we're going to find ourselves in a situation where, the needle may be moving a little bit more towards the IEA's way, at least for this year. And then next year, given, the sort of, again, slow momentum when it comes to China implementing policy intervention, whether it's through the central bank or the government, although they have done quite a bit up until now, next year's growth may not be as strong as well. So that is a one key, let's say, area that matters for oil demand, China. But we also see it in terms of the OECD, where the IEA is taking a more conservative view. And that's further reflected when we start talking about the longer term forecast. You will get contraction in oil demand in OECD countries in general. And the IEA here tends to take a little bit of a more aggressive view on how that contraction may occur. And I think OPEC, as Jorge was mentioning, is certainly has maybe a little bit more of a robust view on economic growth. So it's sort of back to that earlier discussion we're having is when you forecast a delta off whatever base you want into the future, the question is, what are your economic assumptions? What are your sensitivity assumptions to those economic assumptions? And that's going to deliver. And then I'd make a further point, and this is something I think you rightly put. There's an element, of course, and we're going to get to it further in the podcast, but in terms of agendas, OPEC has, through its meetings, but also obviously through its publications, is there to try to shape expectations, right? So you have a bit of a competition and jostle between two agencies, if you will, looking at a picture of global fundamentals. And if there are agendas or not, behind the numbers, and that could skew it one way or the other, right?
Let's get a bit more as well. We're talking about China. I think if you actually look at the forward curve, so you mentioned, Jorge, we've got the backwardation, which is at least 2 months forward for Brent, right? And then you've got down the curve. It's quite aggressive backwardation, I would actually say. And that hasn't really changed. We only got an overhang situation a little bit in the front of Brent, but really in dated Brent, right? The very prompt swaps. So it was very clear that market probably getting ahead of itself and then suddenly aggressively correcting in the prompt. And that's where the prompt contango came in, etc. So now that we've kind of rebased ourselves with, back to 85 on the outright price, where are we right now? So I would say this is the great thing about the derivative market. It's behaviors in the future, right? And actually oil demand in the future. They're actually tendering oil right now in the future. And so you don't need to guess what the interest is. It's there for you 2 to 3 to 4 to 6 months out. And I would say in Dubai market has been weakening, it's been under a lot of pressure. Brent versus Dubai has rallied, which is very aggressively. And yes, there's technicals there. That's a lot of long-term shorts being kind of squeezed out. It could start to correct now, but I think more interestingly in pricing, the Brent Dubai has actually been rallying, right? The Dubai spread has been weakening. That's for quite far out physical indications, 2 months at least. And for that to be relatively weak and for the China demand not to be there. And Chinese buying is definitely not there in dated Brent. So you've got two key location benchmarks where the Chinese state companies are very active and they're actually on the sell side. They're generally not that interested in oil. And I think they hold generally a bearish view of their own crude buying. But that's not to say they don't have the demand. It's just to say that this, from a supply point of view, they're covered. They've got their own production increases, which no one ever seems to talk about. It was talked a little bit about at a conference I was at the end of the last year. But, how do you calculate Chinese demand? You need to imply it. It's what they're importing with the ship tracking and all that. And then obviously what's coming out on the product side as exports that they start to do more and more. And then you kind of gauge it from there. But their production could be running riot for all we know, right? And this is the whole supply and demand kind of divergence. It's not as simple to say, oh, the demand could go up. Yeah, the supply could go up a lot as well. But anyway, you also mentioned NGLs, petrochemicals being the future of demand forecasts, demand strength rather. And playing into that narrative, again, we saw just how destructive the bearish demand story was in the NGL market at the beginning of the year. It really messed with things. We have a very nice kind of correlation between US and Asia, usually in the two regions, and the Saudi propane. It's a function of freight, of course, but with Chinese demand not there, the FEI contracts just got completely destroyed. Seasonally, it was weak, and it was very difficult to trade on the back of that. We didn't know what they were doing. Really, demand just went to a complete halt. And then meanwhile, there's all this petrochemical production online. People are looking to aggressively hedge those margins. So the cheap feedstock everywhere in naphtha and propane it looked like a very bearish story because the Chinese buying wasn't there from the DCE, from them in the FEI contract. And then fast forward, 6 months later, 5 months later, we get all the stimulus. We get the talk of China coming out of this kind of slump. Sorry, not the talk, the evidence of, the banks making the interventions, hedge funds starting to buy up equities after like this almighty sell-off. And people were kind of like quite slow to change their views. So it seemed like everyone was so bearish China, but then all of a sudden they were starting to make, bullish movements in their economy. And then in propane, you did see all the buying. And now we have a huge amount of buying, like quite consistently for the last 2 months in propane. And then naphtha had a bull run. So it shows you how sensitive that market is to China. And if that's the one that's reliant on the demand forecast in the future, it's quite a good proxy for what you're saying. But just to conclude that, it's looking pretty bullish from that point of view. So you would kind of argue that the demand is there on the NGLs from the Chinese side.
This is really the interesting thing, Greg, in terms of a lot of people when it came to looking at naphtha, looking at NGLs, looking at LPGs. The whole feedstock story into petchems is really built, and the growth in that, in the demand for those feedstocks, is built on the fact that we've had massive increases in petrochemical capacity, especially in China. Mm-hmm. So at the end of the day, you build these plants, you're going to have to run them. And then the key question that comes about is what utilization rate you're going to run these plants. You're not going to leave them idle once you build them. So then the question is, well, if demand domestically is weak, then you're probably going to have to operate at, let's say, maybe 60%. You're not going to be fully operating these facilities. If the demand is good, then obviously the rate of utilization increases, and it's more bullish for for the demand for those feedstocks. The thing at the end of the day, and this is again, if you think of what petchem makes, right? We're talking plastics and other chemicals used in the manufacturing process for merchandise goods and so on. If the economy is not ticking, right? If you have trouble exporting to key markets for China,
it's going to be felt in that market.
It's going to be felt.
Yeah.
It's going to be felt.
But just to also add to that, I mean, I've just talked a lot about propane and naphtha, therefore cracking into petrochemicals. But petrochemicals themselves, there was a real worry this year that with all that, production increases the increase in plants, was it going to be bearish for propane because the margins would be squeezed because there's so many producers that actually, as you said, if the demand's not there, they're going to continue to produce petrochemicals as much as they can. And then, so that weakens the margin, but then that weakens propane. And that was the narrative that was gaining a lot of momentum. But again, I know I'm repeating myself, but just to reemphasize, it then completely flipped. And actually the petchem margins have been really good. And then it's been driving this whole like last 2-month rally, which I think is really significant. We're talking the same thing really. But I think outside of that, we've got to talk a little bit about gasoline, because you mentioned like that was the big driver out of COVID. And then again, we're talking about sentiment around price and expectations. And this year we came in, and the talk, as far as I can understand from consensus point of view at the end of the year, was we are going to get a demand increase. It's going to come from China. That's going to be what moves the needle, right? Will be the increase in China's demand. And then it was, and most likely the gasoline demand increase is going to be the most significant of all the products this year in summer, like it has been the last 3 years. Therefore, by Q3 gasoline. And that was just a consensus, right? Everyone piled in. So we've had a very choppy ride after an initial very strong rally. And we're yet to see if this will materialize. But, we talked, you were on Macro Mondays talking with James Brody about all the macro indicators. He came on again the next day. And he's quite clear about the US signals and gasoline not being, like the retail sales being quite weak. It's not giving the strongest indication. So whilst we've talked quite a strong potential forward gain for NGLs and petrochemicals, do you not agree that gasoline is maybe not looking like it could follow through?
Well, yeah, certainly. I mean, when you actually start looking at the U.S. economy and you're looking at whether or not the Fed is going to drive a weakening of the economy to achieve its 2% inflation target, as James was highlighting on Macro Mondays, I mean, there's a lot of telltale signs there that things are weakening, or even just the quality of jobs that the U.S. is adding is lesser, in the sense they're getting more part-time jobs, people either working 2 jobs and so on. So maybe that seasonal summer boost that typically accompanies an increase of leisure-related driving rather than necessarily work-related commutes, maybe that's not going to be as strong. And then the second thing, of course, is in terms of broader macroeconomics, this is where, again, you look at LPG, you look at naphtha, and a country like China whose indicators are showing clear deflationary pressures. Are they going to be able to hold it up? And so coming back to that sort of divide between the IEA and OPEC for this year, we have a couple of things that people are going to focus on. Does gasoline deliver? There's consensus that there's more catch-up room for jet to keep on growing. And then the big uncertainty of, naphtha and LPG demand. So somewhere, I guess, in between the two, there's going to be some element of truth as to where demand growth ends up.
And which products?
And which products, yeah.
Anything for you, Jorge, on that?
Yeah, I wanted to bring back a little bit of the recent history. This whole saga between the IEA and OPEC became bigger because of the recent OPEC decision to extend the cuts into Q3, maybe. And their narrative initially was sort of not very strong about markets. And that caused the market dump, where we almost went below 80. And then subsequent to that...
We did go below 80.
Yeah, but just briefly.
Okay.
And then OPEC went into the recovery in the narrative to make it better. And
that was quite impressive, by the way, because they didn't actually say anything. And they managed to get people more confident.
Yeah,
there was a little bit there. Yeah.
No, what I mean by that, I'm not being facetious. I'm just saying, as in, like, they didn't say that there was any change to their plans, just that they could. So what I'm saying is impressive because it's a politician's move, right? It's instilling confidence without actually making any changes, and that causing a big $8 shift in price. Yeah. When everything's still the same.
Yeah, things are the same. It's just to Jorge's point there's an element of where moral suasion works or not.
No,
right?
Of course, they know that themselves. That's what I'm saying. That's what this is all about. Yeah, that's what we're emphasizing.
Sometimes the market will believe or buy into the story, and sometimes the market won't, and that's when you have...
But it was giving the indication that the market wasn't buying in anymore.
Yeah.
That's what was surprising to me. But I guess that if you combine that with the excess short positioning...
Yeah, we called in the reports jawboning, because it was trying to persuade jawboning.
Oh, jawboning. Yeah.
Which is trying to persuade the market to believe something that actually is not. And then the IEA came in with the forecast saying demand is just going to grow barely over 1 million barrels.
So you can see where the tension's coming. They've managed to get the market confident again, and you got the IE coming China. It feels like
to knock it down.
It's a long versus short.
OPEC comes to knock it up, saying it's 2.2.
Yeah.
At the market, in its infinite wisdom, says, I am with OPEC. Therefore, I will restore the price back to 85. And so they did. And in the meantime, the other realities are grinding away, right? Because in Asia, Dubai is not performing. Dubai fell relative to Brent. And as the prices went up, Dubai is definitely falling behind. Mm-hmm. And right now we see all the major Chinese players, Unipec and PetroChina, selling a lot of Dubai. Mm-hmm. There are some of the teapots selling Dubai. There is PTT from Thailand selling Dubai. Mm-hmm. And we are observing all these markets and saying, what the hell is happening in Asia? Why is everybody selling? And gasoline is not performing in Asia. Even jet kerosene is not performing right now.
So as much as people had hoped, basically.
So yeah. I wouldn't be surprised if in the next few weeks, this wild animal we call market changes its mind and starts running the other way, right?
So longer term forecast, will there be demand in 2030? That was the other thing that IEA recently released, right? It's a medium term outlook called Oil 2024. So this had a leveling off of oil demand by 2029, slight contraction in 2030. This is also upsetting OPEC, right? So Harry, is this scenario even realistic?
Well, I think, as you said, Greg, and I know Jorge has a lot to say about this as well. But at the end of the day,
that's shocking.
Yeah, I know, right?
I have 2 words to say.
Well, let's wait.
Yeah, let's build up the hype. Yeah.
Well, let's get through some numbers. I mean, at the end of the day, Greg, this, as you rightly put it, when you're looking at medium term and even longer term forecasts going out, beyond 2030 to 2050, we're talking about scenarios, right? Mm-hmm. And the end result has to be always viewed in the context of what the underlying assumptions are that drive the forecast. So, if you modify the assumptions and initial conditions even a little bit, right? At the end of your 5-year or 10-year horizon, you could have a very different outcome. So, of course, for OPEC, what the IEA is putting out there is unrealistic, right? Because it has a lot of implications, especially when it comes, as we were talking earlier, relative to investment in the oil sector, but also, when it comes to demand for OPEC's oil itself, right? Mm-hmm. And those are 2 key things that obviously OPEC is extremely sensitive to. So when OPEC looks at the IEA's forecast, it's coming at it obviously from a different angle. The IEA, as we know, and it's a very long-term forecast that you find in the World Energy Outlook publication. They've been used as benchmarks in that whole net zero scenario and achieving that. But even the medium term is important, right? And so when OPEC looks at oil demand peaking, in 2030 or actually 2029, right? Mm-hmm. It naturally is going to react to that and is going to have a different viewpoint. I think that, if when you compare what OPEC had, and I think it was when they released their forecast, long-term forecast last year, right? Mm. There's a significant divergence in terms of the total amount of demand that could be achieved by 2028. And if I'm not mistaken, I'd have to check this out, but I mean, we're talking about figures well in excess of the roughly 106 million that we're going to achieve according to the IEA's forecast. Mm.
This is still, I mean, we're talking about demand, but I mean, it's interesting you talk about...
Actually, sorry, just numbers pop back in my head, but the IEA sees oil demand at 105 million barrels per day in 2030. So last year, OPEC's estimate, medium-term forecast, and their world oil outlook, that was around 110 million barrels a day. Mm. So you're like in 2028. Mm. So that is a massive divergence. Mm-hmm. So the call on OPEC crude oil, or what OPEC should produce to balance the market, how much has to be invested to not only offset decline in mature fields, but grow the supply base to meet demand. There's some serious implications behind a forecast like this, right?
Well, hey, what are your 2 words?
Nobody knows. Absolutely nobody knows. Right now, there is a debate over this year. 6 months have essentially elapsed, and the market is already trading August. So at the most, we're talking about not knowing what's going to happen in September, October, November, and December, 4 months. And we still have a divergence over 1 million barrels per day between the forecasters. So if we don't know 2024, what are the chances we can know or come with a credible estimate for 2030? Zero. These are estimates, guesses, dreams, expectations, but they have very little to do with reality because it's a very political world.
Okay, but what is the reality? The reality is the truth in the price. The price is the reality. So
Correct.
It's about people's sentiment about that. So it doesn't matter what the truth is.
Absolutely
Okay.
correct.
But they know that as well. Everyone knows that.
And the price right now, as we are saying, is 85 with a curve. But we have seen that curve being at sub 80, being significantly closer at 90. So we're changing our mind continuously. And with the people that I work very closely, it's about seeing the line in between while there is all this noise around that line. And the line I see so far is of a price that is close to 80 to 85, no matter what happens. The price tends to gravitate towards that level. And going forward is hitting around $80, no matter what the noise is. What will be the true demand and consumption and supply? We don't know. What are the big things coming? One of the bankers was highlighting to me, keep an eye on Russia. They have a huge development called Vostok, right? Which is along the lines similar to the Guyana, right? It's hundreds of thousands of barrels a day. So there'll be more demand coming in. And
That's supply, you mean?
more supply coming in, sorry. And at the same time, what is happening in Africa? The population there is still growing quite well, right? And more population means more energy demand. What energy demand do they want? Hydrocarbons. They are not into the electricity level yet. So all we can say is any price curve, no matter how it flutters, it ends up being around $80.
I think it's quite important when looking at the IEA's 2024 oil forecast publication is, again, understanding, how to interpret the information that's given to you. So, I mean, it's based on assumptions. And one of the things that OPEC has been a little bit critical in terms of the IEA is basically the substitution approach that they have adopted. So they're looking, and it's quite evident in the weakness over the forecast period between now and 2030 in terms of oil demand declines, especially in OECD countries, right? Where there is substitution going on. And one could debate, the penetration of the EV fleet, related infrastructure that would actually allow this to happen, government policy that would also allow for EV penetration and uptake to actually take place, right? So, as I said, you tweak with the assumptions and you get a very different proposition. So again, understanding that any medium or long-term forecast is based on a set of assumptions to guide a certain viewpoint. Then you're free to change and relax each one of these assumptions and end up somewhere else. Now, the interesting bit is above and beyond how people are looking into further out into the future and the implication it has, right? Because producers are going to be sensitive to someone saying we don't need oil anymore, right? But I remember in the super cycle of, that for oil that started back when China first started really growing back in 2004, 2005, kind of shows my age. But what was very interesting in terms of price, because the proof of the pudding is in the price, is that you had a situation where we had a lot of demand growth and not enough supply. So basically, the back end of the curve started to rise quite significantly to incentivize investment in production, right? Because you needed to produce more to meet the additional demand generated off of China's economic boom. So the back end of the curve was driving the front end of the curve upwards. If we're not going to see that kind of dynamic, right, in terms of back end pricing to encourage more supply, then one could argue that maybe people feel comfortable with the demand supply scenarios, and the price doesn't have to go, as Jorge says, much above 80, and we could stay there. But those dynamics will unfold slowly as we get the real information, or as real as it could possibly be. Right?
If there's one truth I know, the price won't stay $80 for 10 years. The boom and bust cycles, the volatility, the greed, the positioning, there's no way it's just going to be flat. But I understand the sentiment of, where kind of homeostasis is in the long run. As you're talking there, it made me think, well, actually, you're talking about crude back end. And you're talking about, of course, we're talking a lot about crude for supply and demand. But if you look at the oil publication from IEA, they're actually breaking down per product growth into 2030. And it's consensus, right? At the end of the day, LPG, ethane, naphtha, big increases. Interestingly, airline fuel increasing, but gasoline having like a big dump. I mean, that's probably what people would expect generically looking at EVs, right? I mean, that's basically what you were saying as well. But, make a great point about Africa. We don't know. But the point is, you don't need to know. But if you have a strong enough consensus in the products, you will start to see people trying to price that. So if I go back to IMO 2020, it was about early 2018, when the market started to try and price what the subsequent oil market framework would look like once the shipping fuel regulations came in and stopped the use of high sulfur. And the initial gamble was gas oil versus high sulfur fuel oil, and that differential should blow out. And they were pricing that, very, very strongly at $40, I think. I can't remember, I shouldn't say. $40 per barrel-ish, I think, difference in the two contracts. People made a lot of money out of that. But it never actually came true. It diverged.
Sort of like a Y2K moment.
It was, but all this money made and lost, and all basically, the shipping end users trying to protect themselves. What the hell do they do? They buy Brent? Do they buy? We didn't have a VLSFO contract at the time. Do we buy Gasol? And people, of course, were jumping on this, saying, okay, if you don't know, this is a great opportunity for a bank, great opportunity for consultants, great opportunity for these people to come in and create structures. That's what hedging is all about. But if you ask me, that was a little bit naughty of some people, right? No one knew, so you shouldn't be selling like aggressive hedging programs when it doesn't even correlate to the price. But anyway, what I'm trying to say is, all this happened in 2 years. When it actually got to 2020, gas oil fuel oil just came all the way back to historical normals. We just had a new contract in VLSFO, and then kind of everything was okay. But also in 2020, we had data to lead, DFLs in 2024, that versus Brent spreads is a very niche product, but there was a huge amount of open interest on that contract as people were gambling against each other what was going to happen. Brent Dubai, the expectation, Oxford Studies did Oxford Institute, they published a report about because fuel oil should be so weak, and they were looking at the forward curve of 2020 gas oil versus fuel oil, looking at the 2 years out high sulfur fuel oil crack, and determining, well, if you look at Dubai and it has Al Shaheen as the price setting crude, and that produces this amount of high sulfur, then the high sulfur crack is so weak in 2020, therefore the Brent Dubai differential should be plus 20. And people started betting on that. And we're talking like major oil companies going, right, I'm going to buy your sides on 2020 Brent Dubai. It went all the way up, and then obviously what happens is it crashed all the way back down. Now we have negative Brent Dubai, right? So
nobody knows.
Nobody knows, but it's not important because it's what people are going to act on. And it's the most, well, you could say it's dangerous, or you could say it's interesting, an opportunity, whatever. But when I read things like this and consensus builds over fundamental shifts in the market, if it's not going to be crude, like Harry said, it will be products. So you can see people off the bat going, come on, EV vehicles. They're going to basically be long naphtha propane versus gasoline. That's going to be like the most obvious trade in like maybe let's just say right now you can trade 2025 quite easily, probably 2026, 2027. When those forward curves are in play, people are going to start putting on 2 year forward kind of trades like that. Yeah. They don't actually have to come into fruition, but it will. But just before you go, if they cause this big shift in the forward curve between let's say LPG, naphtha, and gasoline, there is a bit of truth to that, because suddenly the economics from gasoline versus LPG are real in the future, that someone can come in and lock in from a hedging perspective and change their production mandates as a refiner, as a blender, as a producer. So it does cause real ramifications, people's trading right now into the future. You see what I mean?
Oh, yeah, absolutely. And again, like, from OPEC's point of view, right, it's basically all about crude that is going to be demanded to make products. But as we're saying, we could have the macroeconomics, the big picture GDP growth, and so on, and then you could start looking at individual products. So the IEA's forecast is saying there is a big, and they're coming at an angle in this sort of net zero scenario of substitution, right? OPEC is coming from a different angle at the whole net zero, where they're looking at complementary energy sources, looking at developing carbon capture, improving and further developing carbon capture technology. And they're not looking in a world of net zero that necessarily has to displace the entire amount of oil demand, right? But whether people choose to believe OPEC, the IEA, a consultant, how the consensus eventually is going to be formed is going to be very interesting in terms of longer dated pricing.
And there will be a bubble somewhere.
There will be
a bubble to buy into, and there will be a bubble to burst.
There was a lot of people back in the first real super cycle in oil that took us to 150, right? There were a lot of people who bought into the Chinese growth story, right? And in a world where we were refinery capacity constrained, and so our ability to make products limited, here comes this giant that steps in. Oh, the people went out there and bought calls on oil way further down the curve at very, very low deltas with premiums that were very attractive. We're essentially taking a gambit, right? And so if China grew, then voila, they were going to make money. In the case here, it's like, if you believe the EV story, right? If you believe that we're really going to have that much penetration of EV that will displace gasoline, you're going to go, right, I'm going to be short gasoline. What am I going to put against that? Right? And everyone and their dog really believes in the petchem story. So this is where naphtha, LPGs are going to be bid relative to gasoline. And then this is where you're going to start looking at, basically maybe shorting reforming margins, so gasoline premiums over naphtha. Depending on which one's going to be cheaper, you may be playing the propane naphtha
That's a good one,
spread.
actually, yeah. Because historically, that's always been a buy.
There are many things to interpret out of these numbers. But again, I don't think the IEA is here. The IEA is not purporting to forecast where the oil price is. They're just trying to give us their scenario of where they see things going, right? OPEC's going to come at a different angle. And
in terms of trading it, I mean, I think, as I said, the IEA kind of result, and they're going into the products, and if the consensus forms, that will be a product play in order to trade it. And I think the beauty of the oil swaps market, and we're going to be making that wider available for people and investors, that's the beauty of it. You can trade LPG and naphtha versus gasoline, whereas you couldn't before, right? So that's a big deal. Whereas OPEC on the side, they're just talking about the crude price, crude futures outright price. So I think in essence, it feels to me, if we kind of like round this around the agendas, the IEA, of course, are talking about, on behalf of governments that want to reduce the use of fossil fuels and move more to EVs, power generation from your renewables, things like that. And they know that they're going to be enforcing that or promoting that or incentivizing that. So of course they're going to see this divergence in what they know that they can't replace and what they can replace. So I don't think it's that controversial to just say, well, at least from our perspective, we know what we're going to be incentivizing. So this is the net result. It's not saying the crude price, whereas OPEC are saying, don't say that, because that's going to change people's sentiment and how they then position on Brent futures. But so there might be different agendas, but at the same time, there's different kind of desired outcomes would be my.
Yeah, and I wanted to add that there's an inconsistency or something jarring in the comments, because if the IEA is incorrect, as OPEC believes it is, then that works for OPEC, because there will be a shortage of oil, prices will spike, they can produce what they have been bottling in, and it will be at a higher price. Everything is fine for OPEC. If OPEC is right, on the other hand, and demand is going up, then the IEA shouldn't oversell lower demand, because it's going to blow up in Europe. And Europe and the US, with their tariffs against China on EVs, are making sure that demand for oil continues. Because if you're taxing cars coming in 50% or 100%, then there will be less of a movement into EVs. So all the organizations seem to be working across purposes against themselves.
And they know the power of words, and that's what this is all about. Any closing thoughts on this, Harry?
Well, I think at the end of the day, when you look at oil demand forecasts, and it's going to be demand for oil products, but where the controversy lies is in the implications, especially for producers. So when the IEA, which represents obviously consuming nations, puts out a view, producer nations, are going to look at that view and draw conclusions. So the IEA is looking at very strong non-OPEC supply growth, right? And then it's showing this demand scenario, which means less of a call on OPEC oil. And if you really want to push it further out, I mean, what does this all mean in terms of, at the end of the day, if we do have true substitution in the way the IEA sees it, and oil demand peaks and eventually declines, this leaves an open question of stranded assets for OPEC countries and producing countries in general. And as much as they're trying to obviously diversify their economies away from oil in order to meet the challenges of energy transition and reduce their reliance, they're still quite heavily reliant on the production of crude oil and the revenues associated with that. So if you have a scenario where oil demand is essentially tanking at one point or another in the future, are you going to have stranded assets where oil remains below the ground? And that's a key consideration when a country is trying to look at its future. And some of the pushback that we see coming from OPEC is basically, you guys rely too much on substitution. We look at it at energy transition in a complementary manner, as in oil will be still part of the picture. So the scenarios you're pointing are a disincentive to investing in the oil that will be needed in the future.
Jorge, closing thoughts?
Yeah, as a follow-through really is the sanction. Nobody knows my term. We don't know what 24 is going to be, but everybody's agreeing that will be higher than last year. And every year, barring the COVID years, oil consumption has been going up. It is likely to expect that this trend will continue for a few years. Can we say into 2030? I don't think anybody knows. It is also very true that EVs are growing, but not really in the West. They're growing in China. So where the surprises in gasoline consumption will happen will be in China. Any further articles coming out say that buyers of EVs in the West are not so into it. And with the tariffs coming in, they will be less into it. But in China, they're buying EVs. Last month, 47% of new car sales were EVs. And according to some of the bankers I talked to, this means that in China, already the demand for gasoline is roughly 250,000 barrels less than it would have been. And that trend will continue into the future. So there will be an imbalance between gasoline demand in the East, in China, not in India, and gasoline demand in Europe and the US, which will be stronger than we think it will be.
Thank you both for that. It was all very detailed, very interesting, coming at it from a few different angles. So I hope listeners out there really appreciate that as well, because it's a hot topic. I think it's going to continue to be, and I think it's going to drive the sentiment for the next few months at least. So just before we sign off, just want to remind you guys about onyxhub.co. Please check out that. Articles, views, opinions, dashboards, public available information, all that is there. We've got Jorge Montepeque's, the officials, and beyond. So please be sure to check that out. Otherwise, thanks again for listening, and see you again soon.